First thing on my mind was you guys talking about Bitcoin moving down. That last space was a couple weeks ago. It's done the opposite so far.
Yeah, I've been quite surprised with how it's kind of responded in the last week or so. Um, it looks like I'd have to pull up on the chart here that the correlation coefficient that you can put on these charts. Let me see what I got here. It seems to be separating from the rest of the market if you compare it to like the NASDAQ or the S&P. Let me pull up the indicator. I mean, they've been highly correlated for quite a while. And just in that past week, you really saw it change up. Here, I'm going to compare it to the S&P 500 and see what I get. What is this? How many weeks ago is this? So like 10 days ago, you were nearly peaked out at a 1.0 correlation to the S&P 500 on Bitcoin. And as of now, you're at a 0.6. So, and for people that are listening, if they don't know how the correlations work, a 1.0 is an exact correlation, a negative 1.0 is a polar opposite correlation. So right now you're at a 0.6.
What do you use to look at that?
And that's all kind of changed recently. You can just go on the trading view and you can, under indicators, you can just type in CC.
Yeah.
And it'll pull up your correlation coefficient. But I've been very surprised, especially considering, I'm surprised the rest of the market's kind of held in the way it has, to be quite honest with you, from the last time we talked. Because the last time we talked, there really hasn't been any kind of like good news, in my opinion. There hasn't been any kind of good news to kind of hold it together, other than, when we last talked, the RSI was kind of pegging itself out, which would suggest that maybe you get a little bit of relief or just a little bit of sideways action. But there really hasn't been any good news since the last time we talked. And now you're looking at
there's been good news for Bitcoin, the momentum, not much for the other stuff.
Yeah, so you got a little bit of a relief rally kind of going in Bitcoin. Now, whether it holds up or not, who knows? But the rest of the market right now is looking pretty scary, at least from my point of view. And I mean, I think a really simple indicator just to kind of know like what kind of sentiment you're in with the regular equity market. You just look at, just like a super trends momentum indicator on like a daily bar, and I mean it's been red, and it's been red since November, end of November on the NASDAQ at least.
Do you look at the CIP tool for that?
Well, so I use that for much longer term trends. If I'm looking for something that's much shorter term, kind of like what we're talking right now, I'll just go on the trading view and kind of pull up some different indicators. But
gotcha.
In general, I would describe the market, especially in the next quarter, as being in a very negative momentum kind of status, at least the major indices. But
and then there's a potential hike even before their next meeting, according to Zero Hedge.
Yeah, well, I just tweeted that one out because I was reading that on Zero Hedge, and I'm like how insane is this that we're still doing QE, right? You're watching the balance sheet run up, and then you have multiple Fed officials saying that they need to do a 50 basis point hike tomorrow or like at the next meeting. It's just it's just insane, dude. Like we are in it's just totally unprecedented, right? And it's screaming that they've just lost control. And I mean, you can't find a person in Twitter finance that's not suggesting that. I mean, I'm not saying anything that nobody else can see. It's amazing to me the spread between the real 10-year yield, which the 10-year closed out at 2.03 today. So 7.5, I mean, or yeah, 7.5. You're at a negative 5.5 spread between the 10-year real yield and the federal funds, which is at zero.
Mm-hmm.
And that's insane, because you go back throughout history and you look at when we had a negative 5.5% real yield on the 10-year, and you look at where the federal funds rate was at that point, and I mean, it wasn't at zero, I can tell you that much. And so it's just crazy. And they're talking, oh yeah, we're going to do a move in March. They're still like growing the balance sheet. It's crazy. They're not doing
Yeah.
anything. And I
I
think
saw a tweet today
for
that
anybody,
said the federal funds rate was 11.5% the last time CPI inflation was this high.
yeah, yeah. And so I mean, think about that. So when you're talking real yields, right? Like they're minuscule when you're comparing those two, because you're talking about that spread between the two. Um, so the fact that you're at zero is nuts.
Mm-hmm.
So and when you're looking at, I think it's funny, every time we kind of start talking, I always start getting into like the fixed income yields and stuff. But people just have to realize like these markets are completely based on the cost of capital, right? Like everybody is conducting economic calculation off of these risk-free rates. And so when you're watching all these durations, especially like everything under the 10-year, well, hell, even like the 20 and 30-year, I mean, everything is just selling off at a breakneck pace. You saw the announcement, another Zero Hedge article with the Japan saying they're going to do yield curve control. And for people who don't know it, I'm just going to very simply describe yield curve control. Yield curve control, as people know, when the yields are going higher, they're selling off, right? When the yields are going down, it's because there's a bunch of people buying it and bidding. When you're watching these yields sell off like crazy and they're going really high, like in Japan, they're stepping in and they're saying, well, we're going to peg the yield and we're going to peg it at basically nothing percent. And as anybody from the market steps in to sell that, we will be a buyer in order to make sure that those yields don't go any higher. So it's effectively just unlimited printing in order to keep that yield at nothing. And you know, Tina's here. I see him here. He made a fantastic comment on that post that I just recently put up about the Japan stuff. And the yield curve control, and he said we have to do yield curve control because we've got to basically debase our way out of this. And he's exactly right. And Lynn Alden's another person who kind of brings this up quite a bit, and they're right. The only thing that I would push back on, they're right, period, right? Like that's what you have to do to get out of this, and that's what you have to do to fix it. My concern is they're going down this path, but there's no change in habit from a fiscal spending standpoint. There's no appetite for a change in that cultural trend of just print and literally shove the money straight into my pocket, by anybody, right? And so if you come up with this really kind of hidden kind of way to solve this through the debasement of the currency and manipulating yields so that they stay low through a thing like yield curve control, that's great. Well, it's not great, but that's a solution if you're actually if you're fiscally constraining yourself to work towards getting back to a normal operating way of doing business to host a free and open market. But what I'm seeing is they're doing that. They have to do it, but it appears like the trend for fiscal responsibility is aggressively getting worse, right? And that's the issue. That's a major issue.
I just pulled up that Japan article. It looks like rates across all durations have essentially been zero. And they stated on Thursday, which is today, that they'll be printing as much as needed to make sure those bonds for the 10-year aren't going above 0.25%. Like, those numbers are just like ridiculous.
It's insane.
At least relative to the US.
Now,
yeah, at least.
Now, as long as you have like positive yields in other parts of the planet, and this is a question I've fielded for years from people, and I mean, I don't know that my response is right, but you know, Japan got here first. They got here literally decades ago, right? People will say, well, how do you know that everything's going to change right now? Look at Japan. They've been doing it for decades, right? And what I would say is, I think we get ourselves into this catastrophic type scenario when everybody arrives there, when everybody's at 0% collectively across the globe. Because as Japan was doing this decades ago, like all that debasement was just sliding out of their economy and just going to other places where there was still like real yields, right? But now that you don't have real yields anywhere, and by a lot, like we're not talking 100 basis points here, we're talking 550 basis points, and that's in the US. Could you imagine what it's everywhere else? That's where I think it starts turning into, and I don't mean to be an alarmist. I don't want to be the person who, there's the solutions to this, right? Like if you really kind of understand what's happening, you probably have the biggest opportunity of a millennia here, right? But I think that I think we're in for some extremely I'll label it interesting roads ahead.
Yeah. I listened to your episode with Urian again today, and I think where you two kind of diverge on your opinions is you think inflation is going to persist, possibly go even higher than where it's at today. And Urian, it sounds like he expects it to come back down, and he thinks they're going to be able to raise rates. And he mentioned that they're going to be able to back off on the back off on them raising rates if the yield curve starts to invert. And you mentioned that you think that's going to happen, summer, fall timeframe, at the latest.
I think what might have got lost in that conversation was just the time horizons that the two of us are looking at, right? So I'm looking at, and this is the value investor in me coming out, I'm looking at like a much longer time frame. I'm talking like 3 to 5 years, like what's going to happen in that time period. I think he was talking more like, hey, what's going to come in the next 6 months? And it wouldn't surprise me in the least bit if this 7.5, and I know I said this when it was at 7.0, but maybe this 7.5 is the highest inflation print you get in this next 6 months to a year time period, especially when you can consider like this is relative to the previous print, right? So in order for the inflation to keep hitting these really high numbers, the prices on all these commodities have to keep running. Now, everyone's used to me posting my fixed income chart, and it was funny. People were telling me today that
it looked like lines.
The crazy looks like the crazy guy with the yarn on the board. I have other charts. That I don't normally post that are very similar to those charts, but that it's all all the major commodity indexes. And when I'm looking at that chart, here I'll pull it up. It looked like a few months back, like it was starting to maybe cool off a little bit. But if you look at it now, I mean, the last, here I'm looking at it right now, let me measure this out. The last 40 days, it's like nearly all indexes are ripping yet again.
Yeah.
In the last 40 days. Whereas I would tell you the 90 days that preceded that looked like maybe we were going to get a little bit of a reprieve on some of the inflation numbers. So, dude, I have no idea, but um, I think this is important. If we keep getting prints above 5% for the next 6 months to a year, like you're still in crazy land when it comes to those spreads to the fixed income market. So even if the inflation would start cooling off a bit, you're still like just grossly mismatched for equities too. Like I'm not just talking fixed income there. Like all your equities are priced at like a 3% return. So they're priced just like the bond market's priced, which is a different universe when it comes to the reality of your base hurdle rate of clearing just inflation alone and the inflation that they're telling you that's being printed. So um, yeah, I mean, I what a time to be alive. That's all I can say.
So another thing that Urian mentioned is that Fidelity was quote unquote an early adopter of Bitcoin. Does that mean just like, bringing clients on to buy it themselves or help them get acquainted with it? Or how do you interpret that?
Well, so I mean, my interpretation of that is like of all the big Wall Street banks, I can honestly say, and I'd be curious to hear what other Bitcoiners think, but Fidelity has always talked very favorably of Bitcoin. Always had like negative kind of take on it. Now, this recent, and we talked about this in our discussion. This recent publication that they just pushed out. I mean, it was like saying stuff that you would see on Bitcoin Twitter by like some of us
Yeah,
hardcore people, right? It was like there's Bitcoin and then there's everything
Bitcoin
else,
only.
and we think, yeah, and we think there's a big distinction between this, and people need to understand that. And I mean, this is coming straight from the top out of Fidelity.
Mm-hmm. I love how you mentioned the hodlers and the tourist analogy. You got the hardcore hodlers and then the people that just come in because it's going up in price, and he gets it.
He did, yeah, he did a great job kind of describing that, and and I think he's spot on. I think that you just get so many speculators in the market, and you see this anywhere. It's not just Bitcoin. You see speculators all over the place because people got numbers that they got to produce for their monthly, performance, and it incentivizes short-term thinking. So that's why you see so much of it. Um,
Mm-hmm.
and I find it interesting that the Jack Dorseys of the world, the Michael Saylors of the world, the people that actually own equity in a business that actually creates value for society, that has a profit, they don't they don't care about the swings, right? It don't matter to them
Mm-hmm.
because they don't have to keep the people that are providing them funds happy for the most part. They can think much more. They're
Mm-hmm.
incentivized to think long term. They're incentivized to not sell and incur a short term capital gains tax, right?
Mm-hmm. I keep seeing from, people that are, I guess I'd say like against Bitcoin or just like don't believe in it. But I'll see on the timeline, they're like, oh, when's Saylor going to be forced out of the company? And it's like, I don't think they understand the type of position he's in
No.
where it's like they think he'll get liquidated or something if it goes to 20K or something.
Yeah, it's laughable. Well, and it's people that don't understand accounting. They definitely don't understand corporate governance. Um, yeah, that's exactly it. A lot of them are from Wall Street, and they've taken other people's money, and that's why they don't get it.
Another interesting point you put out. You said that you're looking into building a Bitcoin mining facility. And I recently interviewed on Millennial Investing Whit Gibbs from Compass Mining because I wanted to dig into his product. He lets people essentially just buy a miner and send it to one of their hosting facilities. And I'm looking at the potential returns on this. Like, even if Bitcoin, stays level for the next year, your annualized return could be something like 100%. Like, I put down 10 grand for a miner and I get 10 grand in Bitcoin over the first year of running it. And then I get to run it for another 5 to 10 years. It's just insane levels of returns, assuming all goes well, of course.
So here's the challenge with what you're describing is, let's say I just buy Bitcoin outright right now, right? And let's say the performance is 100% versus putting an outlay out there that would be a USD based outlay, and then you receive the 100% return on that USD outlay, but it happened, over, the 1 year period of time. As soon as Bitcoin kind of runs harder or less than that, you're going to perform better or worse depending on which two outcomes kind of materialize. So then I think this is pretty much obvious for anybody. Now, where I'm looking at doing it as a business opposed to what the model you just described is, if I stand it up as a business and I do all this organically, I can depreciate all of that hardware and basically write off the net income that you're kicking off. And let me tell you, that tax advantage is massive.
Yeah.
Now, if I can borrow the money to go out and buy that hardware, then it gets really exciting.
Well, that's the other interesting point. Compass actually offers financing. And I'm pretty sure I'd have to work with an accountant, but I'm pretty sure you'd be able to depreciate the expense for, I believe, 3 years, depreciate over 3 years.
Yeah. So are you going to get the same return as kind of doing it on your own by outsourcing it? Well, it comes down to what your electrical expense is. I mean, if you're plugging it into your house and you're getting 12 cents per kilowatt hour versus doing this model through them where you're getting 6 or 5 cents per kilowatt hour, well, you're going to have way better results going with the lower energy cost than doing it out of your house. And so each person's situation is different. Everyone's capital that they can tap into is completely different. I'm looking at doing something on a larger scale. And to be quite honest with you, it's still kind of a difficult decision for me to kind of pull the trigger on, just because it's just too easy to buy Bitcoin and get a pretty amazing return with little effort. Yeah. But I'm looking at the numbers just like anybody else is looking at the numbers. And what's really interesting when you start talking about the debt side of it, like basically going out and borrowing money at, call it 6% or whatever, and then, well, depending on if these interest rates will hang with these inflation numbers, but let's just say you're doing it at like 6% or whatever, and you're able to bang out 100% return in a year. It makes it a really easy decision to borrow money, and it just further increases this quote unquote speculative attack on the dollar, because of just the attributes. And think about it, no customer. I mean, there is a customer. You're providing a service to all the people using Bitcoin, but as far as like, you're not interfacing with somebody. There's very few businesses that you can pump out those kind of margins, and you don't have like some massive capital outlay to get yourself into it, right? Like, you could do that as long as you can tap into some like really reasonable electrical expense. You could start up for like $10,000 or $15,000 and be crushing it. You don't have to purchase a $1 million facility in order to get your foot in the door. It's pretty insane. How many businesses can you pump out a margin like that and scale it almost in a linear kind of way, without some type of hurdle, cost of capital, or not cost, infrastructure expense to get going.
Yeah, I asked Whit what he thought the biggest risks were, and he just said the Bitcoin price going against you and the hash rate ripping.
Yes. There's a lot of variables, and I think that's another piece to really consider. Is I think people they get all excited, they get themselves into something like that, and they just don't understand how how many variables there are to kind of guard against. And then if you're doing it with borrowed money, and let's say you're not the best at operations, you could maybe get yourself in trouble. But I put it out there because it's something that I've been doing quite a bit of homework on. And I good luck finding any type of margins like that anywhere else for not really needing much of a competitive advantage to step into a business right out of the gate.
Mm-hmm. I guess people were also curious why you're avoiding public miners. I'm assuming it's just the multiple that's put on top of them in the public markets.
That's it. So it's everything we just described, but if you're going to buy that equity, so like what you rig, right? That's completely different to me than buying equity in one of these companies. And so when you're buying the equity, you get that depreciation expense, tax advantage that I was describing, but you're dealing with something that all that equity has been chopped up and put into the public market and put into the market at a massive multiple. Okay, so as you continue to go to the right of the timeline, especially if you look long term, like that multiple is going to normalize, especially if you start heading towards a Bitcoin standard, because all of these multiples in equity are based off of these super low interest rates. And everybody's about to find out what happens when you don't have interest rates low and what happens to equity prices.
Yeah.
So that's
and
it. Clay.
That is such a massive incentive for companies, one, to go public and mine Bitcoin, and two, start raising money in the public markets, have that arbitrage and that speculative attack on the dollar.
Yep, completely agree.
Saw that Trey wasn't here. It's like he dropped out though.
Yeah, you can let's pull Dr. Jeff up here. I'm curious what he's thinking.
Yeah. Invited him.
Yeah, it's pretty fascinating to kind of see how this is going to play out, and I was surprised at how well the equity market hung in today. Like it wasn't down nearly as hard as what I would have expected after that CPI print. Hey Jeff, I see you're up here. I'm curious what you think.
Yeah, hey guys, thanks for the invite. Hope you're doing well. Fun to hear your thoughts. Yeah, man, I got lots of thoughts. So, where do we start? So the CPI came in hot. I tweeted a couple days ago that there's a reason why I think risk assets are pumping since kind of January 22nd or whatever the date was. And I think I surmised a couple days ago that I think it's sniffing out that this inflation number is going to come in even hotter, and it did, obviously. From a macro standpoint, that makes sense that risk assets would rally. I hear you that
why is that, Jeff? So that doesn't make sense to me. Why would they rally if they were expecting that to come in hot like that?
Because when you have accelerating inflation, that is generally good for and people don't. The common narrative disagrees with this, but historically speaking, risk on assets tend to do well when inflation is accelerating, and that's just what we saw so over the last month. I think leading up to last month, people were anticipating that inflation, and I was one of the people, that inflation and the GDP had both peaked in Q4 of 2021. So what this tells me, obviously, is inflation obviously didn't peak. It probably just peaked in January. I can't imagine it comes in even hotter for February, right? It's hard to believe it's going to be above 7.5. It might be, watching and waiting. But to me, that says now we have, definitely decelerating GDP metrics and disinflation from here on out. And that combination with a tightening Fed on top of that, and I know a lot of people disagree with me in the audience, but I think that portends very poorly for risk on assets. So that was my signal right when that came out. Bitcoin spiked, miners spiked, all that kind of stuff. I took some profits on some things. I don't talk about individual trading strategies anymore. I've learned my lesson. But I did buy some puts on some things, and I'm shorting the Qs and shorting the S&P 500, and I'm very long volatility as well.
Yeah. So I mean, I just had no idea. If I was going to attribute the balance, I said this at the start here. I don't know if you were on, but it would have just been from the RSI kind of pegging itself out there at the end of January. You might expect a little bit of a bounce just because it was oversold. But as far as like the trend, like, I mean, holy moly! What are your thoughts on on them potentially raising the federal funds rate early?
I think they could, and I think they absolutely are going to, and I think they're going to come in hot with that as well. So basically, what this inflation number told me is we almost certainly peaked in January, and it basically guarantees really poor macro conditions for the second quarter. I think they absolutely have to raise, and they have to be aggressive with it. And the markets don't like that, right? So I mean, this is just like a 1, 2, 3 punch to risk on assets. And again, I don't know how Bitcoin performs, but I do know other risk on assets I think are in trouble. I think they're going to start out with probably 50 bips right off the bat. We'll see what the markets do, and then they're going to keep trying. And at some point, they're going to be forced to flip. We talked about this on your show, whatever, a week or two ago. But I just think the markets are in trouble. It's to me, it looks very ugly out there.
I mean, even if they'd come in at 50 bips on the first hike, they're still 70 basis points behind the 1 year.
Right. I mean, they're just in trouble, right? They're totally behind the eight ball. They should have been doing this, 6 to 9 months ago. Of course, they don't. They never do it when they should do it. So it's just another classic scenario. We're back to 2018 Q4 again. The markets are going to tank. Powell's going to be and then elections are coming up. So at some point, they're going to start getting pressure from the White House. And it's not Trump, obviously, so it's a different pressure for sure. But there will be pressure to get the markets stabilized. So they're just stuck between a rock and a hard place because they have to try to bring down inflation, which they can't really do. I'm actually in the camp. But you were speaking of urine in your podcast. That was great, by the way. Just listened to that this morning. I think that inflation does deflate from here or disinflate from here. So I think regardless of what they do, I think we're going to see decelerating inflationary numbers. But as you say, I think it's going to still stay hot. So by the end of the year, we're still talking 4 or 5%, which is too high.
Yeah. So when, and I don't know if you like the lines on the crazy person chart that I keep, dropping out on Twitter, but when I'm looking at these, I mean, it's really showing that you're getting all sorts of inversion by the summer, by May to June. Is that when you kind of think, and the inversion is at like 2.5 or probably around 2.5 to in between like 2.5 and like 2.7 is what I would guess. So, if what you're saying is that the inflation still comes in at 5.5, and you're getting inversion in the yield curve at let's just call it 2.5 to 3, like you got major issues there.
Yeah, you do. Right. I mean, there's tons of things to think about here, right? Obviously, first of all, if we get the inversion, especially the 10-2 inversion, what that says is with basically 100% accuracy historically is that within about 18 months, we're going to see a recession. So this isn't causing a recession in the short term. We're looking like 2 years out from today, even if it happens really fast. But Lynn Alden does a great job with this, and I would argue that the Fed actually they would never admit this, but they actually want inflation to run hot because it's a way to pay off this unpayable debt. Right, the only way to possibly get out of their debt load is to debase the currency and act like they didn't mean for it to happen. But it's certainly happening right now. We're watching it happen in real time. It does make the debt easier to pay off. So they kind of want this to happen, but they could never admit that because they know they're making life miserable for definitely the lower classes. They're just stuck in an impossible spot right now, and at some point they're going to have to pivot and support the markets again.
So I don't know if you heard earlier when we first fired this up, I was saying that I totally understand that. I agree with Lynn. I agree with what you're saying. They have to do that. They have to implement some type of yields down. But like, unless you change the fiscal trend of spending way more and aggressively increasing the amount that you're spending, you're not solving anything, right? You're just um, you're making it worse, right? Because you're doing these manipulative policies that are, you know, for all intents and purposes, making sure that we don't have a free and open market, and you're continuing to outspend what you bring in, and so it's not like you ever hit the finish line with resolution and normalization of a policy like that, as long as your fiscal side is so broke, and I think it's culturally broke.
Yeah, I completely agree. I mean, we're clearly in the end stages of this credit-based Keynesian economic experiment, right? I mean, they've painted themselves into a corner. Anything they do makes the problem worse. Like, you're darned if you do, you're darned if you don't. They can't do anything to improve the situation, and literally everything they do makes it worse. But people kind of demand that they do something, or they feel compelled to do something. They're just toast. I mean, the fiat is toast, and we're starting to see that. And I think this is the first year where we're going to see, I think, a crisis in confidence in our currency, and people are going to start being like, why would I hold this crappy stuff if I could own some Bitcoin? And I think more and more countries are going to start thinking about that, and they're going to watch the mighty U.S. dollar really crack for the first time seriously. And so I think that's the best marketing you could possibly have for Bitcoin, honestly. But that's they have a massive problem. The rest of us, thankfully, don't. We have a way out this time, and so I'm immensely thankful for Bitcoin.
Hey, Will.
Hey, thanks for. Can you hear me?
Yeah.
Oh yeah, we got you.
Okay, cool. My the little thing that tells you the voice is on wasn't moving, so I wasn't sure. Thanks for having the space. I've been listening. I think since you started, it's been a great conversation. I only have one quick question, just for Dr. Jeff. Like, how much of the selling from these macro funds that are concerned about monetary tightening, how much of the inventory do you think that they've already sold versus what they have left to sell? Because to me, it seems like, obviously this is speculative, but there's aggressive selling over the last few months, and you have to wonder, how much of the selling from these entities in the market that are concerned about, monetary tightening, how much of the inventory have those entities offloaded in a, preparation to risk off for even just, being prepared for something like this potentially happening. And as well, like, if these same type of funds are concerned about offloading their inventory, they're definitely not going to be buying. So who do you think has been buying recently? Call it in like the low 30s. Is it a sovereign wealth fund with 5-10 year time horizon, or is it more crypto native entities? I guess, what's kind of your thoughts on those dynamics?
Yeah. Hey, well, great question. Well, first of all, let me digress slightly over to the equities markets. Towards the end of January, some of the largest buying that we've seen historically among institutional investors was in the S&P 500 in the Qs. Which was kind of surprising, and buying long-dated treasuries. And then, but also there were huge numbers of the same institutional investors buying puts. So they were basically long spot and buying puts for downside protection, trying to go up, sort of like a net neutral kind of approach. I don't have the same kind of statistics, and obviously you know way more about this than I do from an on-chain perspective. But from what I gather from the on-chain is that the OGs and the institutions, they're still buying, and that this price is still just moving on the margin with the kind of trading activity. So the speculators basically still remain. They came positive, they went long for the last couple of weeks, but I think they're going to be piling on short. Meanwhile, the OGs and the increased DCA army for Bitcoin, they continue to just kind of buy as usual and buy up the remaining stock. So at some point it turns, but because I think there's such a small supply, such a small liquid supply of Bitcoin, it's just going to remain highly volatile. And again, I think it's skewed to the downside because of these macro risks. So that wasn't a great answer. I don't actually know the answer to that. And I was going to ask you kind of a similar question and see if you had any insight into that.
Sure. No, thanks for that. Yeah, I think that's just been something I've speculatively been wondering lately is how much de-risking has taken place over the last 2 or 3 months, because we've seen an aggressive sell-off since 69K. And I do wonder, how much inventory do those entities that would be concerned about monetary tightening and something like that would change a long-term Bitcoin thesis, which, I think there's, it's possible that there's several Bitcoin holders that, aren't going to budge on their position because they understand where the broader trend of this is going over 5 or 10 years, and could even still be, anticipating, rate hikes. So in the short term. So, I just wonder, like, how many of the entities, I guess, that, that monetary tightening would change their Bitcoin thesis, how many of those entities have, I guess, already offloaded their inventory. So, all right.
Yeah.
Appreciate the answer. I was just curious what you had to say, because I really enjoyed your recent conversation with Preston on the podcast, and that was like the one thing, I guess, that you hadn't covered there. And thanks for letting me ask.
Yeah, thanks. Well, and I wish I had a better answer, but honestly, I just don't really know. I don't have a good source for those numbers. But that's a great question.
Take it easy, guys. I'm gonna hop back down.
Thanks, Will.
See you, Will. Clay, what do you got?
Let's see. So I was thinking about one of your tweets. It's kind of funny. I'm just going to read it. These are the actions that ultimately release the floodgates and take Bitcoin to the moon. The potential energy is already packed into this thing, like a neutron star ready to go supernova. Yield curve control and UBI are the tools that take it there. Now, it feels like a lot of the bond market is just pent up and kind of stuck. And it makes me think that it's going to be some of the nation states that are going to be some of the massive buyers in the future years. Like, call it Russia this past week saying they're going to, use it as a currency or let it be a legal currency in their country. So I'm curious what your thoughts are around that. We see the bond yield curve sell off, but it's not like those funds are able to move it into Bitcoin, are they?
No, I think that there's a few unique edge case, very creative situations where, like Michael Saylor in El Salvador, but I mean, in the grand scheme of things, from a macro standpoint, those are just an absolute pittance of relief valve of how much, and I'm calling it energy, is packed into this thing, right? But it's there. And I think that's the important thing is when you think about yields being compressed down to nothing on pretty much every financial asset on the planet, there's nowhere to go, right? Like when you ask people, oh, what do you invest in? There's nowhere to go outside of a play on the currency imploding and going to like Bitcoin, right?
Yeah.
So when I think about that as being a potential energy, almost like the pressure in a pressure tank, and they just keep compressing more and more molecules into it, you're going to get to a point where something ruptures. And when it does, it's just all going to come screaming out. And so when I'm thinking, okay, well, like, what makes this rupture? The thing that's going to make it rupture, overusing the two tools. And the two tools are QE. Yield curve control is just a variation of QE that is much more dramatic and extreme. But you got QE and you got UBI. So we're now at a point where the QE has been just so overused. That's why you have your rates down to nothing. And there's still I mean, God, if the Fed's still not moving, even though you're getting CPI at 7.5%. Now that's probably going to change real soon. But just to kind of give you an example of how dramatically overused that tool is, and there hasn't been any use of UBI. Well, what you're creating with the overuse of QE, which is UBI for the rich. It's the easiest way to describe it. QE is UBI, but for the rich, for anybody that holds an asset. So when you overuse that tool and you obliterate the middle class, anybody who doesn't hold an asset gets obliterated. What happens is you start to get this social unrest, and you start to get this outcry and demand for the use of UBI. So politically speaking, like I think that's probably what's going to start to become in favor, especially if we kind of get the reaction that I kind of expect on the horizon here in the next 6 months to a year in the markets, which is you're going to have a significant sell-off. And as that sell-off happens, people who even the people that have been benefiting from QE are going to see a lot of those market caps go back to levels that they didn't think they were going to see again. And it's going to throw things into this state of chaos. And I think that's when it's going to start to become way more politically popular, and you're going to see an outcry for the use of UBI. So now as they transition that liquidity insertion, like you're directing a stream of energy from what was being sprayed into the top of the populace now into the middle and lower class portion of the populace. What you're going to find is, I think, exactly what we saw when COVID happened, and they were, all this triple P money and everything else. Like, you know what people were doing when they started getting those relief checks and the triple P money? They're going out and buying all the stuff that they hadn't really had the luxury of buying before. They were going out and, buying meat. They were buying toys. They were buying anything you can think of. And this is really important. They were paying down, some people were paying down debt. When you pay down debt, that removes units from the system. On a personal level, that's a wonderful thing, right? To people that get out of their indebtedness. But from a policy, if you were sitting in the chair at the Fed or the Treasury, and people, you just pumped out a bunch of money, or you pumped out a bunch of currency into the system via UBI, and people start paying down their debts, what you're doing is you're making it very deflationary, very fast, and also people are going out and spending. So depending on how that UBI would be used, I suspect you're going to see prices act in a very similar manner to what we're seeing right now, which is high inflation prints. Well, the problem you run into, if you keep walking the dog on this, the problem you run into with these 7.5% inflation prints is it makes the fixed income market try to make a sell-off at those yields, right? That market needs to sell off until it gets above that hurdle rate of inflation of 7.5%. So by doing UBI, what I suspect is going to happen is it's going to force them to double down on the debasement, maybe even quadruple down on the debasement, because then they're going to have to do more QE via yield curve control to peg the yields at these really low interest rates. And the way they do that is they got to buy more financial assets. They got to buy more bonds off the market and shove cash into the hands of those owners. And so that's the real issue here when you start getting into the UBI portion, is not only do you just totally distort the price signals, but what you also do is you force the additional doubling down or tripling down of the use of QE. And that's when it really starts to come off the rails, right? And that's where your quote that you read that I put out on a tweet is, all of this energy has been packed into this system to compress yields to nothing in the stock market and in the fixed income market. It's there. The pressure's in the tank. And if they start going more aggressive with these policies, which I can tell you culturally, I don't see a person in sight that's saying we need to be fiscally responsible here. Not a person in sight. So like these policies are coming, as far as I'm concerned, from a probability standpoint, they're coming. And I think once they start really using them, you're going to see this thing just totally go. Um,
Everything's gonna rip.
yeah, it's just going to totally just turn itself inside out,
Yeah.
man.
They sent out like 4 stimulus checks after COVID, and GameStop went 10x, and Bitcoin went,
Yeah,
all
yeah.
these risk-on assets. I mean,
And when you study any type of
yeah,
currency failure, like that is what you see. Is you see everybody become a speculator. Everybody turns into, oh my god, I need to sell this used car right now for a profit, and I'll go drive something out. Like everybody's just trading anything and I mean, they're out trading Pokemon cards, they're selling baseball cards, they're doing anything that has some form of scarcity to it, and they're trying their darndest to just like somehow have additional buying power through the act of doing things that add zero like economic real value to society, um, but they're doing it in the name of trying to protect themselves, right? Because that's what this is. This is the ultimate race to try to protect yourself from those types of activities.
I just brought Aarika up to the stage. Welcome.
Thank you so much for having me. My name is Aarika Rhodes. I'm a congressional candidate running against Congressman Brad Sherman in 2022. I'm an elementary school teacher. And Preston, it's good to be on a stage with you again. We just did one with Jack Dorsey last Friday on this very topic. And, I know that there's a lot of controversy around a universal basic income in the Bitcoin space. And I want to remind people that, there's so much government waste in current government programs that are failing and not pulling people out of poverty. And I think when our team went through the whole federal budget and we started looking at through all of the different government programs, means tested programs end up costing more than the actual program itself. And so I think when I personally advocate for universal basic income, it's not because I think we need to just give people money. I think that we have current systems that are not effective and they're not really solving problems, and there's a way to implement it without having to print the money. And I think there's also a lot of potential with the Lightning Network, which is something that I'm still trying to figure out how we can do that, and I keep talking to people in this space about. But I think that for me, the expenses come on the back end when people actually end up falling into, let's say, chronic homelessness or poverty, or they get that one unexpected bill that puts them into complete financial ruin. And a universal basic income, and I think Bitcoin, could prevent that from happening. With Bitcoin in particular, I think it's an opportunity for people to acquire wealth. I think it brings economic justice, especially for people of color and low income, people that where the banks tend to not give the same loans. And I think that banking fees keep people impoverished and pawn shops. And so I really appreciate the fact that you're having this conversation. And I just really encourage people to learn more about the government programs that we have in place and why it might be advantageous to have an alternative. And so I just wanted to share my 2 cents. And, with Brad Sherman in particular, I think it's a very unwise move to try to ban crypto and Bitcoin and take that position. I think any person in Congress should really honestly do their due diligence because, there's a lot of economic gain and financial freedom for it. And I think that people should be able to invest however they feel that's best for their life. And so I just wanted to give my 2 cents. So thank you so much.
Thanks, Aarika. Anyone want to come up with some questions?
Okay, while we're waiting for people to come up, I wanted to chuck out a couple of things. First of all, Aarika, it's good to meet you. I'm Jeff. Really glad you're. Oh, I think you dropped off. Anyways, really glad she's running against Brad Sherman. He makes me about as nauseous as Elizabeth Warren does. So I would love to see him leave. Second, just getting back to Preston, what you were talking about earlier, I just feel like the way to sum it up and how to think about it is clown world monetary policies literally lead to clown world investment and speculative decisions. So, these GameStop and these other just crazy things, NFTs just going up 1,000%, or 1,000x. This is just what happens. Again, end stage fiat currencies. Like, this is what happens when you debase a currency, and people can't rely on sound monetary policies anymore. So we're seeing clown world economics playing out in front of our eyes, and it's only going to get worse before it gets better.
Trey, did you have a question?
Hey guys, sorry about that. Can you hear me?
Yeah, we got you.
Oh, hey guys. Yeah, I had a question around Preston, your thoughts especially on the fact that we're passing these bills now. There was another one that just went through the House about trying to keep the US competitive. So we're actually proposing to spend money on things that, objectively look pretty useful, like research and AI and things like that. And it's passing real government money to try and fund things that might, in fact, make the US more competitive over time. Are you for or against something like that, just out of curiosity?
Here's here's the tricky situation we're in. We've become so accustomed to having the currency, the global reserve currency of the world, that we have abused, in my opinion, we have abused that privilege so much and to such an extreme extent that it's almost like we need to go on a detox, right? And just like pull everything back until we can control our spending habits, right? So like it's been brought up multiple times. We have to do yield curve control in order to debase the currency to help pay the bill, right? Well, that works if we get ourselves under control and we can bring this all back. Meanwhile, like all of that, like if we're going down that path, like to a sound, uh, like somehow elected officials and the central bankers, like we're allowed to like self-govern ourselves, which throughout human history has never been possible. A sound money policy has always failed. You've always come off a gold standard because of human nature, right? So it's not that I'm pessimistic. I'm just, I think I'm very realistic in the way I view human nature, in that I don't think we can self-govern ourselves. Bitcoin, so going, and I'm getting to your answer here in a real roundabout way. Bitcoin forces the sound money upon the world equally, and it's not something that you can kind of step in and adjust the ledger of currency that's riding on top of it in any kind of way because of the way it settles. So to answer your question, like I think all those things are great. I could list 50 things that I think would add value, right? That our government could spend money on that would be good for the people, and good for the country. But the problem is we're not even close to living within our means. That would make it sustainable to get back to some type of normalcy. Like it would literally take like 50 years if we all of a sudden started like trying to become like to self-govern and get back to like sound principles. And that would be probably being very aggressive. 50 years.
Yeah. So the reason I bring it up is because I was just interviewing Richard Duncan. He just wrote this interesting new book, and he's borderline MMTer, as you know. And I like these arguments a lot because it's more fun to just see what to bat him around. But one interesting fact I took away from the book was he's proposing that you could spend something like the government could actually do the opposite of what we're saying here, and they could spend, let's say, 10 trillion more dollars over the next 10 years on initiatives like that. And comparing it to times in World War II, where we kind of opened the floodgates with the money creation, and that resulted in things like, terribly, atom bomb, but like technologies and things that really just happen once you can really take away the hurdles from funding. And the point I'm trying to make with that that I thought was interesting was, you could spend $10 trillion over the next 10 years and have no ROI. And then we would still, as a country, only be at 150% debt to GDP in 10 years at the current growth rate. And that's where Japan was 20 years ago. So the argument I think he's making is, we could go ahead and spend 10 trillion more dollars and still be where Japan was 20 years ago. And in the meantime, see if any technological advancements come from that, or miracles in healthcare, et cetera, et cetera. I'm just kind of
I
really
think
interested in that.
I think a lot of these people are making bad comparisons when they're saying, "Oh, well, we did something like this in the 1940s and 50s, and we were on a sound money policy. Like, we had gold backing through this period of time, right? As we were doing these, and you weren't dealing with people who could sit down. How many people are in this room right now? 1,300 people in a room where people could openly discuss how anybody holding a bond is losing 5% a year, in a way that, like, everybody now knows this. Everybody's now talking to all their friends about it. The technology has changed the awareness of how you're getting your buying power stolen from you than it was back then, on a quote unquote sound money policy, even though they were adjusting the money multiplier. And that's why we had to come off the gold standard back then. Right. So, like, let's pull the thread on that idea that you just said, in that you're going to continue to compress yields down to nothing. Yeah, Japan did it 20 years ago, and we brought this up earlier, but the rest of the world had real yields, and so all that debasement just got sucked straight out of their country to all the other countries. Now we're collectively at zero, right? So, like, I just don't buy it. I think this is way different than back then. And here's the most important thing that's different. Culturally, as a society, are looking to the government to solve our problems, opposed to taking that upon ourselves and having self-responsibility, right? Like, that's the difference. Back then, they weren't culturally where we're at. We are broke. We are rich, spoiled kids that are looking for a handout. Like, people spray painting other people's doors saying, "Where's my money?" Right? It's indescribable.
Yeah, I think, well, you're also, I think, referring to the wealth disparity that is inevitable in that
Absolutely.
case, right? But that's my argument towards that, I guess, would be the wealth. And here's the beautiful thing about Bitcoin: the you can get in for one sat, $1 if you want to. And so I'm wondering, does it just become an educational dilemma around getting younger folks, especially who are starting out in the world, into, instead of a 401k, into a Bitcoin savings account, to then compete, or hedge against the inevitable inflation that I think we're just going to continue to see?
I think price action is going to do all the talking. And I think people who suggest that, like, I heard Mark Cuban say this. Mark Cuban was like, "You don't have to convince me. You got to go convince your grandma." And I'm just like, no, you really don't. Because the people that are going to, like, you don't need somebody with $100 to buy into Bitcoin to make the price go to the moon. That's not the person taking the price to the moon. The person who's going to take the price to the moon is the guy sitting at some bank on Wall Street who sits on $1 billion bond tranche that's now going to reallocate his capital because he's losing 550 basis points every year because inflation's at 7.5% and he's sitting on something that's yielding 2%, right? Those are the people that are going to take this thing to $1 million a coin, not your friend with $15 in his pocket.
So, sorry, I'm stealing a lot of time here, Clay.
No, I love
that's
it.
all right.
I love this.
One more question, I guess, would be, so let's stick on that for a second and say the U.S. adopts Bitcoin and we kind of get ourselves back on a hard currency, but the rest of the world doesn't. And let's say China does what Richard Duncan's talking about and they spend $10 trillion and they create AI or whatever that, and they get some advancements going and we become less and less competitive. What's worse, I guess, in that scenario? The fact that we would adopt a sound money policy or get further behind in advancements and competitiveness?
Well, the problem with what you're describing, okay, and I understand the quandary, the setup there, right? I think the problem for China is the whole world's going to move to this standard because that's what the population's going to demand. The population as a whole collectively does not want to get debased in their buying power. And so they are going to demand that they hold their value in something that protects their buying power. Okay, so let's say the majority of participants around the world are moving into this sound money, and China isn't, and they're debasing because that's they want to have their yuan. Their yuan's not going to be able to keep pace with this, right? They're going to have to debase it in order to continue to fund all these things. So you get to a point where it's like, well, nobody wants the yuan, right? And then they're going to have to debase it even harder to try to achieve their own quote unquote network effect with their currency. And so I see that as that's just a total losing battle that they're up against. Now, that doesn't mean that it might not work for, in the short term, but I'm talking the long game, right? The long game, all roads lead to people storing their buying power in something that's not going to be debased. And I think that when you start looking at how investment, how are people going to invest their capital? Well, they're going to require a much higher return when they're giving up their Bitcoin, which retains its buying power. Those hurdle rates for getting a return are significantly higher, which means that you're going to have way less investment than like what you have right now, at least in my opinion. And again, I'm talking a very long time horizon here. And I think, to be quite honest with you, I think a lot of this tech needs to slow down because I think it's actually outstripping humanity's ability to handle it. Is that a net benefit for the U.S. when it comes to AI? I don't know. Here's the better question: is AI something that can hide from commoditization? I don't think that it is. I think it's going to be fully commoditized. And I think that the companies that are housing these AI algorithms are incentivized to commoditize it because then everyone stores their data on their cloud servers, right?
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.